some work. Hopefully you can all hear me. So it's welcome to Hot Forex again, Global Trends 2017, an update for the rest of the year from some work that we did at the end of 2016, at the beginning of the year as well. So welcome everybody again. So today we're going to go through some bit of admin before we get started. Usual procedure: if there's any problems with the recording or you can't hear me, try restarting the GoToWebinar software, or indeed the device you're listening on. Any questions or queries, anything you don't understand, please email us at webinars@hotforex.com. But more importantly, stick a question in the question box and I'll answer it here and now during this session. Okay, so before we get going, I just need to read through our disclaimer, which says this material is provided as a general marketing communication for information purposes only and does not constitute independent investment research. Nothing in this communication contains or should be considered investment advice or investment recommendation or a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in FX and CFD product is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk which the users are solely responsible and liable. We assume no liability for any loss arising from any investment based on the information provided in this communication. And finally, this communication must not be reproduced or further distributed without our prior written permission. Okay, so that's the admin out of the way. Just quick run through who I am. My name's Stuart. I'm the market analyst here at Hot Forex. My background is, I've done lots of different jobs in my life, but my background has been 20 years in the City of London for working for investment banks and retail banks. And I've been investing and trading myself since September 1997. I remember it well, 20 years this year. 4 key things I would distill over that time is if it's probable, do it, keep it simple. Look at multiple time frames, but by far the most important thing is the psychology of this business. So you need to know yourself, understand your risk levels, be able to accept a loss, have some patience, have some discipline, and the rest will drop into place. So all this talk we're going to look at today about the fundamentals of the markets and which way they're going and which way what do I think, doesn't really matter, does it? What I think is what actually happens. So for you to make a success of this and to make money, you need to know yourself. So accept that you'll lose, and if you can't accept losing, go and do something else, because trading isn't for you. But there isn't another business in the world I've come across where if you do things and follow some simple rules, you can make a very handsome return on what you're doing, and it's a good investment of your time as well. Okay, so we've got a question here from Diego. I would like to know your ideas about where EM currencies are going in 2017. Okay, I wasn't going to talk about that, Diego, but I'm happy to. And particularly the Turkish lira and the South African rand. And both of those have been in the news recently. We'll talk about those as well, Diego. That's not a problem. And gold, yes, gold I'll have a chat about as well. Gold's on the charts, and it was in the 2017 review. Okay. Not a problem, Diego. There's a lot to talk about EM currencies as well in general, not just the lira and the rand, but we'll have a look at those as well. Okay, so we're here to help. You know, the whole process of these webinars and our training and the stuff we put up on the analysis page is to help you become a better trader. And that's so there aren't any silly questions. There aren't any things that don't make sense, because we all have to start somewhere. Whether you've got a lot of experience, whether you've got no experience, trading is a process. So we'll have a look at the current global trends, stuff I wrote in December and published in February. The first quarter, how's it gone? Where we're going from here, and obviously any questions you may have. So let's jump ahead too quickly. So any questions you may have. Okay, so hopefully most of you have read or downloaded or scanned at least the global trends document that we put together. It was a bit more concise this year. We tried to reduce the amount of words that were in it, so it's about 10 or 12 pages, I think, about the key events and the key political, economic, and what the charts were telling us at the end of the year and at the beginning of the year. So the key chart above all others was this one, the dollar index. Dollar is king, okay? Like it or not like it, dollar is the most important. The US dollar, the USD, is the most important currency in the world. It dominates reserves, it dominates every transaction. All commodities are priced in dollars. So what the US dollar is doing is important to all of us, wherever we are in the world, whatever our opinions about trading we have. So we need to have a look at this. So the US dollar index is something you should have up on your trading screen. Not necessarily something you trade, I mean you can trade it, but something you need to be aware of. So here was the chart that was published in, I think it was in February this chart came from, when the document finally went out. So here it was still generally bullish, and the lines on here were the sort of target that the possible distances this index may have moved this year. This is the weekly chart, and these are the old. This is the original chart. So the blue line is my favorite moving average, 20 period moving average here on the weekly chart. So generally we'd had a very bullish movement for the dollar since the election of President Trump back in the beginning of November. So we'd had a big run up back over this key big psychological number of 100. And it dipped down a wee bit at the beginning of the year. It had a poor January, but it spiked up again during the latter half of February. So the dollar was looking still relatively strong, and it still looks, relatively strong from this point here back in middle of 2016. So 100 is a key psychological level, a key pivot point. We was thinking, it looked 103, 106 as a potential level, and even as high as 115 was a much obviously higher potential. But that's a long way to go. But it's not outside of the realms of possibility, given the bullish talk that was going around about the dollar at the time following the election. Obviously, to the downside, we spent a lot of 2016 down here below 100 at 96, 98, 95, 97. We put through it on here as a support level, and then the low here going back for a few years now, 3 or 4 years, back to 2014 was this 92 level. So we had a very spiky January for the dollar index, and it came down here. This is chart going back to the beginning of last year. So we'd had this run up after the election. We'd spiked up, and then January was particularly negative. We'd had this big sell-off, and we'd broken below the 20 period. And as you can see here on this weekly chart, we're still below this green key line. Sorry, these charts are a bit different, but basically this is the Bollinger Bands, but the green line is the one I'd like you to have a look at. This is the 20 period moving average, the one we were looking at on the previous slide. So here we were above it, and as we update to April, end of the first quarter, we're below. So we've dropped below the 20 period, and we're still below it, and it looks like it's looking fairly negative for the dollar at the moment, because the key psychological number that I always talk about, this 100 level, we're below it again this week. We've been above it for 2 weeks. We were below it the week before. We were below it before. So it's becoming even more critical to the direction of the dollar this year. So it's below 100. So the outlook for the dollar has waned during the year. However, the thing I wrote in at the beginning of the year still holds true. I still think we will get 3, along with everybody, lots of other people as well. It's not just my thoughts as well. The consensus thought, really, or the median thought is where I'm going there, is that we will have 2 further rate rises this year. June and September were the ones we were talking about. I always thought it might be backloaded, so my view hasn't really changed. It's looking at September and December for me. There was talk earlier in the year of a bullishness of even 4 moves this year, but again, my view is that we will move. It might not be June. It's more likely to be September and December where we still get these rate hikes, because the Fed is in danger of ending up behind the curve, and we can't see that. So all the bullish talk about the Trump trade and the reflation of the investment in infrastructure and the cuts to tax have all hit the buffers of the Washington political system. Obviously, the healthcare bill was the big one that caught the headlines. It didn't get through, and there's questions obviously over his next move now with tax reform, which is going to take longer than perhaps it was anticipated, and this infrastructure spend. So again, question marks over the dollar. But I still remain fairly bullish on the dollar, but and two rate rises still, but for now later, perhaps later in the year. But obviously, if the dollar's going to rise, it really needs to be back over this 20 period moving average, and on this 100 level for the longer term needs to be broken as well. So weak dollar at the moment. How long that goes on for is questionable in my view, because the run on the dollar tends to have its to be quite limited, but at the moment we're against the dollar. Okay, so that's my view on the dollar and on the States. Generally, the data's been relatively positive over the first quarter out of the States. Some of it's quite good. The earnings season is starting now. It's a bit weaker than anticipated, but generally the bullishness is here. So we're coming into May. So, from a stock market point of view, it tends to be quite weak over the summer, and then picks up again during the third and fourth quarters of the year. So still relatively bullish stocks and the dollar in general, but obviously there'll be opportunities and volatility on all those trades and assets as we go through the year, as there is every year. So nothing's really changed there, except the dollar's weakened bit more than you would anticipate really on that one. So we've got a weaker dollar currently through the first quarter, which was January was particularly bad. Now it's compounded as we've moved forward. So next big one was the euro. Doom and gloom was surrounding the euro at the end of the year. I could see parity. This is the chart again from the from December, from the publication. 105 was the key pivot point I was talking about then. Weak euro, way under this 20, the blue line here, the 20 period again. So euro was looking weak. It struggled over 105, 107, I think, obviously when this chart was put together. So it was looking to perhaps have a go at 102 and 100. What's happened since? And moving up was the big key pivot was 110, and it looked quite a long way away at the time. What's happened since, there's been a shift in tone from the ECB. There's been a shift in tone from some of the big banks, and a lot of their longer term targets of parity and below parity. Some were even saying 98.50 here. That has changed. They've upped their targets, and there's not many of them now have a target, if any of them in fact have a target of parity for the euro. So as with most markets, as with all markets over time, they tend to get either overbought or oversold, and the targets get extended and they overreact. So we've moved down quite significantly. As you can see here, this 105 level is going back a long time. 102 was a key level. We didn't get down there, and so far the euro has recovered again based on the general more positive feeling coming out of eurozone, that the unemployment's ticking down a little bit, inflation's ticking up a little bit. Mr. Draghi or members of the ECB became quite hawkish for them, to be honest, earlier in the quarter, and the euros picked up accordingly. So here we are, this key 105 pivot level that we were talking about at the end of the year has held, and we've ratcheted up even over 108 to earlier in the quarter, and 110 now looks much more attainable for this particular cross as well. And RSI's rising here on this weekly chart. We're above the green line here, we're above the 20 period moving average. Weekly turning up a bit. So obviously the longer term we're way below this 200 period. So it's still relatively weak, but for the next quarter or so, we could see some buying in the euro area. Obviously, the big issue at the beginning of the year, when we first put our document together at the end of the year, was the three key elections: the Dutch election, the French election, and the German election later in the year. The Dutch election hasn't gone the way many were worrying. Kurt Wilders, the nationalist candidate, didn't poll as well as it was expected, and the Dutch have turned away from the extreme view, so that sort of cooled and calmed the markets in particular. The French election first round is actually this weekend. It's right upon us, but it hasn't really spooked the markets. As you can see here in these weekly movements, it hasn't really freaked out the euro at all. It's a four-way split at the moment. The extreme view of Mrs. Le Pen becoming French president really hasn't taken a grip. There still appears to be quite a few undecided voters in France. So, but the way the French system works is that she's very unlikely to actually make it to the Elysee Palace, to the presidential palace. But it's just the influence she may have on politics. So that the right-wing candidates have moved to the right, further to the right, and the left-wing candidate that was way off the radar even a few weeks ago, Mr. Mechelon, I can't pronounce his name correctly, apologies for that, but he's come back into focus. So we've got we've got an extreme right-wing candidate, Mr. Le Pen, we've got quite a strong left-wing candidate, Mr. Mechelon, we've got an independent, Mr. Macron, who's looking like the young new face of French politics, looking like he could be the preferred candidate of the centrists. And then there's the right-wing candidate, Mr. Fillon, who's had a lot of negative press about his relationship and his employing his wife and all that sort of thing. But he's still in the mix, and he's breaking up that extreme right-wing vote. So the theory is that Macron and Le Pen will go through to the second round, but Macron will become president, so as he takes the middle ground right-wing vote and the left-wing vote, as the socialist vote that has collapsed, and the extreme left will come in to support him. So that explains why that really the French bonds haven't collapsed as people were expecting, or the euro hasn't collapsed, or indeed the French CAC 40 hasn't collapsed. So you see the impact of the French election hasn't had the impact we were anticipating. Again, obviously, don't count your chickens before they hatch, as they say, because obviously there's a lot that could come out in the actual voting itself. But first round this weekend, and then the second round is beginning of May, and then the German election is the key one. Mrs. Merkel was seen as a shoo-in up until a few weeks ago. She now has a strong opposition party in Martin Schulz, but even so, the markets are looking that Mrs. Merkel will stand and will become or retain the chancellorship in Germany as well, and that's steady as we go for Europe and Europe's biggest economy in Germany as well. So. Obviously, also this quarter, Mr. Trump has hosted all the key leaders: Mrs. May, Mrs. Merkel, Abe from Japan, and more recently, obviously, Xi Jinping. So that's had a mix on the currencies as well, and the euro dollar is the one that sort of takes that as well. So euro relatively strong, compared to what it looked like at the beginning of the year. So it's holding up. And again, now it's closer to 110 than it was to parity a few months ago. So it's doing okay. It's better than anticipated, and technically, I say it's in this upper half of this Bollinger Band on the weekly chart. So the worry about the election seems to be being taken in its stride. And the reason for that, or one of the reasons for that, sorry, I was going to talk about the pound. It's the yen's next. I'll come on to the pound in a minute. Next one is the yen. Now the yen is probably the one that's really benefited from this worry on the dollar and the general risk-off situation we've had with the worries that have geopolitical worries that have rose. So here at the end of the year, the end of January, when we put these charts together, we were looking at generally bullish dollar again. So like we had from the dollar index, we were looking for highs at 121 potentially from 2015, 2016 was this next, looked like there was going to be this next rally up as we'd come down, and then we were looking to come up the 20 period here, supported really well on the weekly, and that was looking relatively positive, and the key point here was 115 for the yen. That was a key point here during the first quarter. And what a turnaround we've had. So this 115, as we were here at the beginning of the year, has turned around quite aggressively. So we've had a big sell-off of the dollar yen, or it's more buying of the yen is what's happened, and we've broke a key level just this week. The reason this one's got a few more lines on, I'd left the 200 period moving average on this one, and yesterday, in the last few days, we've actually broken through on the daily chart. And we'll see where this weekly candle finishes, but it's actually hit this support down here, this 200 period moving average. So this is a real interesting chart. We've had a big negative move for the dollar, positive move for the yen. Below 115, as we were talking about earlier in the year, 110 was one of the support levels we broke that significantly. We hung around at 111 for a while, and now we're at this 200 period moving average as well. So the support levels we were talking about earlier in the year, 106 and 101, which we saw for quite a while at the end of or during 2016, again, could be in focus again. It's the exact opposite of what the Japanese government want, what Mr. Abe wants. They don't want a strong yen, but with all this geopolitical unrest, with the situation in North Korea, the issue over Iran raising its head again, the protectionist policies of President Trump, the squeeze on trade, it's all adding to a flight to safe haven, and the rally we've seen in the yen and gold, which we'll look at in a wee bit. So also, just relating to what Diego was asking about EM currencies, they've also benefited from this sort of general weakness or that's kicking around the dollar. So EM currencies are becoming higher yielders and have been of a bit more interest. And if we've got some time at the end, Diego, I'll pull in the chart of the rand and the Turkish lira for you as well. So yen has been as yen was the big beneficiary. Sorry, the dollar yen was the big beneficiary of the Trump trade, of the rally. So we've had it's also been a turnaround quite quickly because of the rise in the geopolitical risk and the risk-off situation that we were anticipating because of the situation as it accrues at the moment. But that won't last forever. The standoff with North Korea will work itself out. It's obviously it's political manoeuvring, pressure on China to do something, or the Americans being seen to do something, and obviously the missile strikes have been taken that way as well. So that's obviously all added to these tensions and added to the rally in the yen and the gold price in particular. So that's, as it was the biggest beneficiary, it was also the biggest sufferer as the dollar moved down. A really interesting one, if we'd done this yet on Monday, the pound would have still been looking like very, very weak. But obviously things change and events are really moving this market. So here we were at the beginning of the year. Pound was looking quite weak. We were down here. We touched this 120 level on cable, this 35-year lower under 120. And it was looking, relatively still very, very weak because we were way under the 20 period here on the weekly chart. We hadn't been over that until since the Brexit vote. Very, very simple trade. Many positions. Very short the pound. Very, very simple. Adding to positions when these key levels broke. So we broke 130, we broke 125, and 120 was looking close again. So 122, 122.23 when we put this chart together, looking very, very weak. There was talk of buyers down here at this 121, 122 level, these historic lows, the longer term plays. That the pound couldn't stay down here. It was fundamentally undervalued. The British economy had held up quite well post Brexit. The recession that many had anticipated now is one of them hadn't happened, and people were still spending. But is it just putting off time? And inflation was back, so it was all quite negative for the pound. The Bank of England had reacted so to down, so that was more down pressure. But there's talk of more hawkishness coming out of the Bank of England. So the pound sort of recovered a wee bit from here. But what happened, obviously, yesterday was a great big sort of monumental shift. It's not very clear on this weekly chart, but we'd had some. We got to this 120 and we'd had a general drift down again, but we'd had a recovery from sort of the end of February through March. The pound had started to gain some friends and some momentum against the cable, against the dollar. So here we've held above the 20 period, and we were sort of going in this sideways. Let's ignore this week for the moment. We were sort of going sideways, and 125 was a key resistance level that hadn't been broken. What happened yesterday was the announcement of a UK election, a snap election. Markets were caught by surprise, not quite sure what to do, and we've had an immediate positive reaction to the pound. It went through 126, 127, 128 just yesterday, so it was a 2.5% move in one day. Will it get to 130? Well, it might do. Will it get to 135? I don't think so. It's too much of a stretch. 130 is a key support level after the big shock of the Brexit last year. But the Brexit fundamentals haven't changed. So as I wrote this morning, I think this is a bit of a stretch, and we may be coming back down into this level below these 128s quite quickly, quite shortly. So that's events. The political event there is that Mrs May wants a stronger mandate. She's expected to get re-elected, and that's the probable event. She'll have a bigger majority, and therefore that will strengthen her hand in Brexit negotiations. So that's good for the pound. That's the markets are seeing that as positive. The pound, however. Brexit obviously will still happen. Mrs May stays in, but the pound, if Brexit is going to be successful for the UK economy, the pound needs to not get overvalued. So it needs to be around really, sub 130 level in my view. Against the dollar in particular. So I think this very knee-jerk reaction might continue for a wee while, but I can see we'll be back into this, potentially back into this level quite shortly as well. So things are looking quite good in the UK relative to the Brexit. It's a real unknown. Nobody's left this great EU club before, and so nobody really knows what the real outcome is going to be. And 2 years is a very short period to negotiate such a significant thing. And cable and the pound has been the main way for the markets to exhibit their uncertainty and their worry about it. So we went from this 150 level on pre-Brexit day all the way down to sub 120. So a huge move for the pound, and it's helped exporters, but UK is a net importer, so overall it's negative for the UK from a balance of payments point of view and from a general deficit point of view. So generally, things are doing okay in the UK, but as far as sterling's concerned, it's going to ride the rally as it goes up, but 130 is a very strong resistance level for me, and 135 for me is a wee bit of a step too far. So we may get over this level and end up settling here, but it could easily come back down here. Obviously, the next 7 weeks will dictate that, but we could be in this 130 to 135 level as well. Okay, so sterling, very interesting, very much in focus, and the one to play. The commodity currencies I touched on in the report quite briefly. I put them all together, but basically the Aussie has been very much in a range bound for a while against the US dollar. It's had a really good 2016. It's topped at 77.50, bottom at 75, and we're sort of down here again today, or currently. So it's been positive. Lots of good news out of Australia. 25 years of expanding economic growth, but the Aussie dollar is getting a wee bit too strong as far as the RBA is concerned, so they've talked it down, and we're at a key pivot point at the moment at 75 against the US dollar, and that's a combination of dollar weakness and Aussie dollar weakness. So they're both weakish currencies at the moment, particularly the Aussie dollar, and so we're pivoting around this 75 level. But 73 isn't that far away, and it wasn't that long ago we were down here. With the rally in the US dollar, so we could easily end up back down here again, and also 71 zone as well. So one to watch. Key dependent on China. The hard landing in China didn't happen last year. massive amount of exports leave Australia, commodities, manufactured goods, to the Chinese economy. Something like 30 odd % of exports from Australia end up in China. So key dependent and a key indicator of Chinese activity, the Australian dollar as well. Its near neighbour, the New Zealand dollar, a soft commodity exporter, not dependent on the Chinese economy, but not as many of their exports. I think it's about 18% of Kiwi exports end up in China. But again, relatively weak. The key pivot point here was this 70 level on this weekly chart here. You can see we're below the high time frame. We've had a good 2016. That may be over with the rally in the dollar. We're under this 20 period as well, so relative weakness. Support down here at 69 or 68.77 we've gotten here, but this point 70 level, big psychological pivot point again. So if this pair are going to go north, we need to be above this 20 period moving average here in the longer term. So 70 key pivot point, and we might bounce between these two as we move forward. The currency that I called it the potential star currency for commodity currencies for 2017 was the Canadian dollar. Obviously very closely related to the oil price. Had a big sell-off as the oil price come down, and it's drifted up generally through 2016 as the oil price improved. Obviously the US is a big oil producer, and Canada as well. So the Canadian dollar has sort of improved. We rallied to as high as 35.50. That's a big resistance level up there for the dollar against the CAD. And the CAD was pushing it. We've pushed down to 130 as well. And so again, we're in a bit of a sideways movement, this pair. But 134 is a key pivot point as we move forward through the rest of the year as well. But as the US dollar improves, so this will tend to tick up if indeed it does. But CAD could be the star performer, could be an interesting currency to watch, because it could benefit significantly from being the US's nearest neighbour. They've got to get on. Lots of Canadian exports go to the US. Lots of US exports go to Canada. Mr. Trump is talking about ripping up the NAFTA agreement, the North America Free Trade Agreement with Mexico and Canada. But they're intrinsically tied, Canada and the US. So it's not going to go as extreme as perhaps he's anticipating. So I see the Canadian dollar being much more of a beneficiary of that than the Mexican peso, for instance. Again, we'll see how that transpires out the rest of the year. So commodity currencies, they've obviously benefited from this risk-on issue that we've had, and gold was a key one. At the end of the year, 1200 was a key pivot. We were looking at 1300 as an upside target. 1365 had been the high of 2016, and 1477 came out as a technical high from I think it was 2011. I can't sure. It was quite a long way back. The big rally, the fall we had was supported at this 1120. We tracked all this down all the way down there. We had this big rally back up. It ran out of steam at 1250 and come back down to 1200, and it was sort of going sideways as we put this together. So we could still see some potential downside, but only if this 1120 broke, and then it was all the way down to 1060. And what a quarter we've had for gold. We've had a complete turnaround, haven't we? A big risk on this bottom here at 1120 has been turned around, and we've had a big rally. So we've rallied from 1150 through the pivoting 1200 level here. I can't see that very well. The resistance was this strong 200 period moving average here at 1250, and then we've just gone on in the last few weeks. 1250, 1260, 1270, 1280, 1297 I think it touched on the futures market, gold early last week, and 1300 now. Seems inevitable, doesn't it? As we've come up, we might have rolled over here, but as we here, it seems a long way from here, and indeed it is. But it can move very, very quickly, the gold price, in times of worry, and that's exactly what's happened here. We've got this 13 level as a key and how long the dollar weakness continues. In my view, is questionable, but this just looks too close to not get there. It may not, but we'll see. Big round numbers, and it's still relatively positive because we're up here over this is the 20 period here, way below. Ignore the blue line, that's just a shorter time period moving average, but strong gold market, and it's not one that doesn't look like it's rolled over yet, although last week was may have run out of energy, but we'll see. It might be just a rest because we've had such a strong move in the last 4 or 5, 6 weeks. So gold still relatively strong. I say 1300 looks inevitable. Has it got any more legs from there? Well, a lot of it depends on what's going on in the States and the dollar in particular. Oil was another one. Oil was stuck in a strong range between since the you can't really see on this weekly chart, but it was stuck in certainly in the daily range, stuck between 51 50. Actually, you can see a wee bit here. So it's this range here we were looking at. It had been stuck in this range 54 to 51. The big spike up here was the OPEC agreement. And as we were putting this together, as we put this chart together, there was a big fall down because there was a huge build in stocks, in inventory. It was 8 times bigger than expected, and it caused a real big spike down in the oil price. I think the day we were putting this chart together, I think so. What I wrote in the actual document was not invalidated, but the support I talked about, $50, had been broken as we put this chart together, and we went even lower. It was quite a big spike down, but the movement, the support was way down here at 45, and even the low of 2016 down here at 40. But I was because of this move here, I was relatively bullish to 56 and even 62 because the move down, there was no real sort of hesitation. So going back up, it probably could have got back to the 60, 62 level. But what we've had since is a big move down. Where are we here? So here we had this big move down, and we've come down 40, 47, 46, but we've recovered since, and we're back into the channel we were talking about before here. This one here, between 54 here and 51 at the bottom here. So oil's recovered quite well. It's relatively positive. It's hanging on, broken through the 20 period. It's hanging on. The Bollinger Bands are starting to move up, but again, it's obviously got strong resistance at this 54 level. But 56 still remains a possible target, and then 62 later on in the year potentially as we move into the key driving season for US oil, and that's key demand area as we move into the second quarter. Is that pivot points you were using, Sir Libby? No, Libby, the lines on these charts are simply my manual support and resistance lines. When I'm looking at these longer term trends, I tend to do it manually. I tend to do it myself and just see where I see the support and resistance levels coming out. And 8 times out of 10, not 9 times out of 10, but 9 times out of 10, I'll say 8 times out of 10, let's say that, it tends to be these key round numbers. So say 56 is a wee bit higher than where it's been, but that's a target you could get to. $50 was a key pivot point, and that's just where I see these levels manually again. Okay, so these are all just something I do manually. They're not sort of worked out as the mechanical pivot points you can find out there on the web. It's my view of my charts, on my trading view, and that's what develops my own belief in what I do and how we teach people to move forward as well. So it's really yes, round numbers. It is easy, and it's because, as I always say all the time, this business is 90% psychological. It's about people. Yes, there's lots of robots out there now. There's lots of algos. There's lots of EAs driving markets. But they're all written and programmed by people. And people are psychological beasts. We have fear. We have greed. We have emotion when we talk about money. And so the psychology of it is that there will be lots of stops and lots of targets around these key psychological levels. And so sometimes markets don't actually get to them. But more often than not, they do. Because that's where we tend to place stops and targets, and we're comfortable with round numbers, and it's just what happens over time. You can look at any chart for any asset over any period of time, and you'll see this repeating itself time and time and time again. Zeros and fives in particular are big, and round numbers. The markets tend to get to them and tend to move to them. And then sometimes the indicators that you use just compound that and reaffirm that. So when you stick on your Fibonacci levels, so if we stuck a Fibonacci level here from here on this chart from the bottom to the top, you'd be amazed at where the Fibonacci levels came out. They come out of these key psychological levels, or they tie up with ATRs sometimes as well. And that's how we trade, how we find our targets and our stop losses. Learn to do it yourself, and that's when you can really move forward. So oil, I know another one that's looking to pick up this year, and it was going sideways for a while, and we had this big sell-off. There's talk of further OPEC meetings at the end of May. It's just been announced today, so that's supporting the oil price. But there's two big geopolitical events around oil. One is obviously the US is as OPEC caps its production, the US just puts more and more rigs on, and the US rig count, you see it every Friday, has been ticking up for the last 12-16 weeks, something like that. They've been going up every single week, more and more US rigs going out into the plains of the Midwest and drilling for shale oil. So they're ready to go and add into it. So any demand that's required is being fed by the US market as OPEC caps things. So we'll see. So the global glut in oil is it going down? Well, it's really difficult to tell, I would guess. There's and the world moves on as well. That's a story for another day as well. So oil, gold, that was it really. They're the key currencies or crosses I wanted to have a look at. If Diego, are you still here? Is Diego still here? I think he's still here. Oh, he's still here. Let me go. I'll bring up, as he's asked for me to look at a particular chart. Let's bring this up for him. Which was the I haven't got the Turkish lira on here, Diego. But this is obviously again. Actually, this is let's do the weekly. The South African rand was progressing really well, thank you very much. And obviously the political events that happened a few weeks ago obviously spiked that growth. So as an indicator for the EM currencies in general, Diego, you can see the South African rand is a really good example of that. It's ticked up nicely during the latter half of last year, particularly during 2017. It's strengthened quite well, and obviously Mr. Zuma sacking his finance minister had a big worry on the market. So we've had this big spike up in the dollar, only for it to be in the second week got even worse. We are up to 13, but remember we got all the way to 17 last time he did it. So it's still relatively strong. And the thing that I've noticed, actually, I was looking at this earlier in the week. I know it's been Easter week, but the fact that we're now back under the 20 period here, that's suggesting inherent strength in some of these EM currencies. This general trend here, obviously on this weekly trend, if this week closes back below this 20 period here, that's quite a significant move for the South African rand to strengthen again, because as you can see, it's the dollar here has only been over this 20 period a few times during, this is going back all the way to last year, only a few times. So the rand's had a really good run, and it's looking to perhaps recover that. So when you get these huge candles like this, you can see this might be half recovered. It's strong, but it's come back quite. So if the 200 period here, sorry, it's 150 this one, but this may provide some resistance, but it's looking like that trend might have re-established itself even after these 2 weeks here. So as the rand continues to be a place of interest for big investors. So I hope that's answered your question, Diego, and I answered your question on gold as well. Unfortunately, I haven't got the Turkish lira here, but again, very much event-driven currency because of what's happened with the referendum and Erdogan winning the referendum and becoming president with lots and lots of powers. So again, you see the technicals here completely blown out of the water with some key fundamental moves. Actually, let's see if I can find the Turkish lira for you. What I've got here. How long have we got? Yes, we've still got some time. So let's have a look. Market watch. Dollar rand. There we are. So, didn't mean to do that. File. New chart. So let's just get rid of that. Let's just bring that up for everybody. So let's go to the weekly on the other one. Let's see. Put a template on it that makes a bit of sense. Let's do that one and take it to the weekly. Okay, so again, we've had the same weakness in the or the reverse situation here with the Turkish lira. We've had the weakness in the Turkish lira as the dollar's accrued very significantly since the election, and a big rollover as a dollar's weakened. But the uncertainty of the election, the referendum in Turkey has sort of been taken into account. Let me just bring up the daily one. You see, it hasn't created that much of hiatus here in the crosses here because of the general weakening of the dollar. So it's weakened off. It's pushed finally below this 20 period, but it's still a currency that's weak, and the extra powers that Erdogan has will get for himself, will that be able to stimulate the economy again? Because lots of infrastructure projects were in Turkey were funded by overseas investors, particularly Gulf states. Lots of big projects all stalled, extra bridges, roads, tunnels. So he needs to reinvigorate the economy there, and that'll be a question as we move forward. So it's the rand looks much more attractive than the lira, certainly as an investment. So we'll see where we go from here as well. But the players seem to be, the EM currencies in general seem to be some areas of interest. Obviously, again, the geopolitical impact cannot be taken away, and they tend to react more aggressively or more significantly, like we saw with the rand, than some of the more developed currencies. So things like the South Korean won has obviously suffered quite aggressively because of the rise in the tensions in the peninsula. The Indian rupee has been doing quite well as India's recovering. The ringgit in Malaysia has been under a bit of stress as well. So EM generally, you've got to pick your currencies really, Diego. That's all I would say. And obviously the Mexican peso, again, I haven't brought that up here, but again, the Mexican peso is another one that has suffered under the Trump administration. But how many of these policies he'll actually push through is yet to be seen. So that's about it, really. That's my views for the rest of the second quarter and third quarter. We got some more tomorrow. Jay's going to be talking much at the other extreme of the market, scalping strategies. Next week, we've got some live analysis. We'll look at some live charts. And then actually my trading, putting it all together, entries, stops, targets, risk management, money manager, a significant session on how I trade, my approach, and how you can, not copy what I do, but understand what I do and try and fit it in your trading style and your time scales as well. And then at the end of the month, a final roundup on Brexit, which will be quite interesting given the announcement about the UK election as well. So thank you for your time. Are there any questions or any general things that I can cover now, or you'd be interested in me, but I haven't covered, or wasn't clear, or any chance it didn't make sense to you, or any currency you'd like to take away with you? Because in May, we're going to be running some seminars in South Africa. So if you're in South Africa, come and join us, come and meet us. Cape Town, Durban and Johannesburg on Tuesday the 9th of May, and then we open our office officially in Johannesburg on the Thursday. So if you're in South Africa, come and join us. So any final questions before we close today? No? Okay, well, I'll call it a day. My book list here, again, as I said yesterday, I say every day, if you only buy one trading book, buy this one, Edwin Lever, The Reminiscence of a Stock Operator. I read it again last week. It's 270 pages. You can whip through it quite quickly. Some great nuggets, as relevant today as it was when it was first written in 1923. And if you know yourself as a trader, you'll understand this book is a great little asset. So thank you for your time. I will speak to you all again next week. Any questions, email us at webinars@hotforex.com. Follow us on analysis.hotforex.com, and we're on Facebook as well. It's Stuart, Hot Forex, Cowell. Come and join us there. We put some other stuff up on there as well. Libby's just asked, do you have price action strategy webinar, sir? Yes, Libby, I'll send you the link to the past webinars site as well about trading intraday and price action strategies as well. Okay, thank you for your time, and we'll see you all the next week. Okay, take care. Bye bye.